Hello everybody, I'm Aaron Heselhurst. Welcome to the program. Of course, it's always good to have you with us. Now we'll talk about what we're starting to hear very shortly from the IMF and of course its view on the United States. But first let's talk banking, because as we know, it has been more than 3 years since the darkest days of the banking crisis. The failure of Britain's Northern Rock and America's Lehman Brothers back in 2008 certainly shook up the industry. Well, today a British independent commission has published its thoughts on just how such a crisis can be avoided in the future. Now, it says investment banks should be, well, kept at arm's length from retail operations, but not split up as some had advocated. Well, let's get more on this because Chris Roebuck is visiting professor at the Cass Business School here in London and joins us. Chris, always good to have you with us. So that was the big, I guess, the controversy before we saw the findings of this preliminary commission's report. To split or not to split? The commission says not to split. A bank's going, whew, we've dodged a bullet.
I think there's going to be discussion going forwards, which means that the positions may move. But the key thing that the Commission recognised was that to some degree, a bad bank is a bad bank. It doesn't matter whether it's a retail bank or an investment bank. And if we look at the situation in UK, of the 3 banks that were rescued by the government, 2 were actually retail banks. So it's a case of we need good risk management, we need some money for a rainy day, and we need good leadership. And that's the recipe for good banking.
And talking of money for a rainy day, talking about these capital ratios, what the banks are being told to set aside, as you say, for a rainy day. At the moment, it's all hovering, say around the 7%. But
Yep.
This commission recommends that the banks in the UK, including retail banks, hold 10%. So my mathematics, every £100 they lend out, they've got to keep £10.
Yes, and that's because they want an element of stability, and it's the first time really that people have been talking about a significant amount of money for the retail side of the business. It was primarily the investment side that people viewed as being slightly riskier, where they said you've got to have the reserve. But obviously a 10% reserve makes sense, and hopefully what will happen will be that this figure will be picked up by Basel and G20 and maybe become a common figure globally, which will mean that British banks are fitting in with everybody else.
And perhaps deemed not, well, some are saying not less competitive. But you talk about Basel and of course the G20 and in terms of how much they've got to keep aside. Basel 7%, the G20 is around there, although Swiss banks, right, 9%.
9, yeah.
We keep talking about when we look at these, the global picture and banking regulation, everybody says it's got to be global to work, it's got to be global to work. What's the likelihood of everybody agreeing to what they need to set aside?
Well, in terms of the balance of risk and capital, that 10% figure, it's perfectly possible that people could move between 8%, 9%, 10% and come in on something that really isn't likely to make one particular jurisdiction significantly out of line with another. And that's really all the banks are asking. All they want to do, particularly the British banks, is be in a position where they aren't at a competitive disadvantage.
Okay, Chris, great stuff as always. Thanks very much for joining us. Chris Roebuck from Cass Business School here in London joining us. Okay.